Do you want to own a vacation home, but you think you don't have enough capital to get started? Well, you're not alone. This is one of the biggest barriers that people face when considering vacation home investing. But here's the truth: you don't need a huge pile of cash to make it happen. And I'm here to show you exactly how. So, in today's video, I'm going to take you through how to finance a vacation home with limited capital. Whether you're a first time investor or just getting into vacation rentals, I'm going to walk you through three key strategies: exploring accessible financing options, leveraging partnerships, and starting small to scale up over time. So stick with me, and by the end of this video, you're going to have actionable steps to begin your vacation home investment journey. So let's start with financing options. A lot of people assume that they need to have hundreds of thousands of dollars in cash to invest in a vacation home. But there are several financing options designed to help people just like you get started with far less capital. So let's break them down one by one. FHA loans are one of the best options for first time homebuyers, and they're particularly useful if you don't have a huge down payment saved up. With an FHA loan, you can get started with as little as 3.5% down. But the downside is that an FHA loan is typically for primary residence. But there's a workaround if you're willing to think creatively. If you purchase a multi unit property, up to 4 units, you can live in one unit and rent out the other units as vacation rentals. This strategy is known as house hacking, and it allows you to generate rental income while meeting the FHA's requirements to live in the property. After a year, you can move out and convert the property fully into a rental. FHA loans have less strict credit score requirements with a minimum score of around 580. And additionally, your debt to income ratio should be below 43%. In terms of the down payment, as I mentioned earlier, it's as low as 3.5% of the property's purchase price. But this is for buyers with good credit. Some lenders might require up to 10% if your credit score is lower. Now, if you already own a home and have built up equity over time, you might want to consider a home equity line of credit or a HELOC. This option allows you to borrow against the equity that you've built up in your primary residence, meaning that you can access funds for the down payment or renovation costs on a vacation home. Now, HELOCs, they often have a lower interest rate compared to other loan products, and they work a little bit like a credit card, meaning you only pay interest on the amount that you draw from the line of credit. So if you need $30,000 for a down payment, you can borrow that amount, leaving the rest of the credit line untouched. Now, the requirements are that lenders typically require that you have at least 15 to 20% equity in your primary home. You're also going to need a good credit score, usually above 620. In terms of repayment, HELOCs have two phases: a draw period, typically 5 to 10 years, where you can withdraw money, followed by a repayment period, often 10 to 20 years, where you pay back both the principal and the interest. Another great option, especially if you're planning to rent out the property, is a DSCR loan. This loan is based on the income the property generates rather than your personal income. DSCR loans focus on the property's rental income and its ability to cover the mortgage. For an example, if your vacation home will bring in enough rental income to cover the monthly mortgage, you're more than likely to qualify for a DSCR loan, even if your personal income or your credit score isn't ideal. Now, there are some requirements. Unlike the conventional loans, lenders are more interested in the property's cash flow potential than your personal income. However, you're still going to need a credit score of at least 620 to 680. Now, in terms of down payment, these DSCR loans typically require a larger down payment of 20 to 25%. But the fact that they focus on the property's cash flow makes it a great option for investors who plan to rent out their vacation home. So, next, let's talk about partnerships. A lot of beginner investors overlook the power of partnering with others to reduce both costs and risk. By teaming up with one or more investors, you can share the financial burden and lower your exposure to risk. Co investing is one of the simplest and the easiest ways to partner up. You and other investors or a group of investors can pool your resources to cover the down payment, the closing costs, and the ongoing maintenance expenses. This means that you don't need to come up with the full capital amount on your own, and you all share in the profits. Now, another way to partner is through a real estate syndication. Now, here's how this works: a group of investors pool their money to buy a vacation property, and one of the investors, known as the syndicator, manages the property. You can take more of a passive role, contributing only capital, while the syndicator handles the day to day operations. Now, of course, it's essential to have a solid partnership agreement in place. This document should clearly outline how the profits and the expenses are going to be divided, as well as who's responsible for managing the property. A clear agreement is going to help you avoid any misunderstandings and make sure that the partnership runs smoothly. Now, this last strategy is crucial for long term success. Starting small and scaling up. You don't need to just jump into the deep end with a luxury vacation home in a high demand area. In fact, starting with a smaller, more affordable property can be the smartest move. Smaller properties typically come with lower purchase prices, which means a smaller down payment and lower monthly payments. For an example, you might buy a cabin or a condo in a less competitive market. Now, these properties still generate rental income, but they allow you to build equity without taking on a huge financial burden. Now, as your vacation rental generates income, you can use the profits to reinvest in larger properties. And over time, you're going to build more equity and be able to scale up to bigger, more profitable vacation homes. And don't forget, having a mentor or a coach can make a huge difference. They can guide you through the process, help you avoid costly mistakes, and give you strategies to scale your portfolio effectively. Now that you know how to finance a vacation home with limited capital, it's time to take the first step. Go to vacationpropertyexpertnetwork.com and download my free book, Vacation Property Secrets, for even more tips and strategies on making profitable vacation home investments. And don't forget to join my expert network for exclusive classes, coaching, and investment fundamentals. Just click that link below. Thank you so much for watching, and make sure you subscribe for more tips on vacation home investing. And feel free to leave a comment below if you have any questions. I'll see you in the next video.